Wall Street has always had a complicated relationship with Bitcoin, but now, a small group of public companies is making things more interesting and more divisive than ever. They're on a mission to buy as much Bitcoin as they can, and it's forcing a major debate among traditional financiers. Surely leading the charge is a company now known as Strategy, formerly MicroStrategy. They were way ahead of the curve, starting to stack Bitcoin on their balance sheet back in 2020. How did they do it? Mostly by taking on debt. But with Bitcoin's price soaring nearly 700% over the last 5 years, that bet has paid off big time. The company is now sitting on billions of dollars in unrealized profits. What was once a modest business intelligence firm has transformed into a Bitcoin Treasury powerhouse. This wild success has been incredibly lucrative and has inspired a wave of copycats. While some are cheering this on, others are raising serious red flags. As of now, Strategy holds over 640,000 Bitcoin. That's more than 3% of the total 21 million BTC that will ever exist. They've paid an average price of about $74,802 per coin. This means Bitcoin's price could drop by 30%, and they'd still be in the green. But here's the catch. That average price has been climbing fast. Bitcoin is famous for its brutal crashes, sometimes dropping by as much as 80%. Could the company's executive chairman, Michael Saylor, keep the lights on if that happens again? We saw a similar situation in 2022 after the collapse of FTX. Bitcoin plunged from $69,000 to just $16,000 in a year. Strategy held on through that downturn without selling a single coin, even with $4 billion in paper losses. But here's the difference. Their crypto holdings have quadrupled since then. Next time a crash comes, those margin calls might be a lot harder to ignore. A Strategy is ever forced to sell, the fallout could be massive. For starters, it could trigger a Bitcoin death spiral. Imagine the panic selling from other investors as that news breaks. The crypto market doesn't have the same liquidity as traditional markets, so a huge dump from Strategy could cause a disproportionately massive drop in Bitcoin's price. Since Strategy's stock often moves in line with Bitcoin, its shares would plummet too. But it gets worse. Last December, the company joined the Nasdaq 100 index. This means millions of everyday savers who invest in Nasdaq tracking ETFs could see their portfolios get hammered. People with zero direct interest in crypto could end up suffering if this company implodes. And Strategy isn't the only one playing this game. Many of its copycats are in an even riskier position. Take Metaplanet, a Japanese company that used to be in hotel management. They only started buying Bitcoin in April 2024 and have paid an average of $106,000 per coin. That leaves them very little room to breathe if this bull market loses steam. Even with limited supply and high demand from companies and ETFs. Some critics point out that Bitcoin's value has risen as much as you'd expect given all the new money pouring in. If that trend continues, things could get messy. Michael Saylor has positioned himself as a Bitcoin evangelist, trying to convince as many businesses as possible to follow his lead. After years of campaigning, he hasn't really moved the needle with the big players. Large-cap companies still prefer holding cash. Saylor even pitched directly to Microsoft's board, arguing that converting some of their cash reserves to Bitcoin would add hundreds of dollars to their stock price. The result? A staggering 99.45% of Microsoft shareholders voted against it. Amazon faced similar calls, with investors arguing that inflation was eroding their cash pile. Some even claimed the company had a fiduciary duty to hold Bitcoin. This brings us to the core of the debate. What exactly is a company's fiduciary duty when it comes to Bitcoin? Critics say it as incredibly reckless to expose shareholders to such a volatile and immature asset that has nothing to do with the company's core business. But proponents fire back, arguing it's even more irresponsible to ignore an asset that has appreciated 77% in just 1 year. Outperforming gold bonds. and the S&P 500, one way or another, one side of this argument is going to end up with egg on their face. And if Strategy's infinite money glitch turns out to be a fatal flaw, the contagion could spread far beyond the crypto world. What do you think? Is this a brilliant new corporate strategy or a disaster waiting to happen? Let me know your thoughts in the comments below. Thanks for watching. And if you enjoyed this video, don't forget to hit that like button and subscribe for more content. See you next time.